Okay, well, thank you for dialing in, and we'll begin now. In collaboration with the lodging industry stakeholders, on March 31st, earlier this year, we hosted the first webinar on the state of the Canadian hotel market to provide support and direction as we started dealing with the difficult effects of COVID-19. That was less than 3 weeks after the World Health Organization declared COVID-19 a pandemic, and we started seeing the shutdown of economies globally. At that time, we had limited clarity on how severe the issue was and how long we would be shut down. What has transpired since that time has been beyond everyone's initial expectation. The restrictions on business activity and travel have caused a tremendous impact across all market industries, and especially in the hospitality business. The drop in occupancy and resultant RevPAR declines has imposed unprecedented challenges, not only to hotel owners and operators, but also to investors and lenders. Here we are 90 days later, and I am pleased to welcome back the inaugural panel who are here to account for and substantiate the statements and predictions they made on March 31st. Welcome back, Brian, Carrie, Dee, George, Kenny, and my co-host, Mark. It is truly a pleasure having you all back. We have a full house, again, surpassing 1,100 participants. Testament to the knowledge, wisdom, insight, and guidance you're all about to and expected to share. I would like to point out that as we have done in the past, we hope to address questions from the audience. You will see an icon on the bottom of your screen, so please go ahead and send your questions in. Both I and the panelists are able to see these questions and hope to accommodate as many as we can during the session. There are three broad themes that have emerged from our discussions. First is, what's the real-time performance and what's the outlook? The second is discussions around liquidity. And the third is a look into the capital markets to address valuation, investor sentiment, and availability of capital. Like we did on our first webinar, I'd like to begin our discussions and ask Carrie to provide us with some real-time operating performance and also provide some comparison to past events that caused disruption so as to provide a sense of the scope and depth of the current event we're grappling with. Carrie?
Thanks, Alan. So 90 days later, I mean, the first thing we can say that we survived. I'm not sure too many of us would want to have repeated those 90 days, but we're here today. So, congratulate us all for that effort. So as Alan mentioned, the original call was March 31st. We weren't at the bottom at that point. We hit bottom the week of April the 11th. So that was the worst week we have on record for Canadian occupancy, which was 12% occupancy for that week for the hotels that were operational. And according to STR, there was close to 20% of the rooms in the country were shut down. And likely at the point of April 11th, that would be the peak of the shutdowns. ADRs bottomed out at about $101. And that was down from $155 in early March. So we went from $155 rate to $101 rate, and we stayed at that rate for about 7 weeks. We have had a turnaround. So we were 3 weeks to the bottom, and now we're about 10 weeks into a recovery. And last week, occupancy was 25.6% for the country, with an ADR of $110, almost $111. So we're still off on terms of RevPAR by almost 79%, but that's down from the decline at our lowest RevPAR decrease was 87.6%. So we're moving back into a positive direction. No province was spared, no region was really spared from this downturn. The performance and the numbers in BC were a little bit higher than the averages. Newfoundland ended up being at the bottom in terms of overall performance, but really, we're talking about a difference between 10 and 20% occupancy. So nobody was operating at levels that were profitable or productive during any of this time period. And the same thing coming out of it, we really don't have markets that are faring very well yet. To give some context, China bottomed out at 10% occupancies about 2 months before we did in Canada. They're now operating at 50% occupancy in China. The US bottomed out at 20% occupancy, so somewhat higher than either China or Canada did. And US bottomed out about the same time Canada did in mid-April. The US is now back to 44% occupancy. So they seem to decreased at a less dramatic rate than we did and have recovered somewhat quicker than we have. Our trend looks a lot more similar to Europe. So the bottom in Canada was similar to where 12% was similar to Europe, and we're continuing to be in a similar place. So when you look at the overall numbers, and as Alan mentioned, we'll talk a little bit about prior cycles just briefly. SARS and the financial crisis SARS 2003, financial crisis in 2009 are really the last two big downturns that we can point to see what kind of declines we saw in those terms. 2003 for the country, we had a RevPAR decline of 8.9%. The financial crisis in 2009 was a 10.7% decline in RevPAR. Year to date for Canada through April or through the end of May, we were down 47% in terms of RevPAR. So, you know, again, back to the context of it, not that we all haven't felt it. This is more dramatic than anything we've seen. And so it's a real question of how long is it going to take to recover from this turnaround. In terms of green shoots, it's one of the things I like to look to, you know, where's the optimism? We can see some rebounding numbers in places like the Okanagan Valley. So we know that there's going to be a recovery from domestic leisure travel first. So at the bottom point of the cycle, the Okanagan Valley was running 12.9% occupancy, similar to what the bottom was for Canada. Last week, they were running 37% occupancy. So there are markets that are going to come back a little bit faster. Banff was running 3% occupancy at the bottom. Last week, it ran 25% occupancy. Domestic travel is going to come back first, but the question really remains how long till we start to see some of the other forms of travel and you know, convention business travel that make up a base of what we're doing. So I will leave it at that, and then we can kick off the conversation.
That's great, Carrie. Thank you. Thank you very much. You know, you're talking about the recovery, and I know that we want to spend some time on that, given that we're starting to see some of the markets open up. You know, the one thing that that we've talked about, and I think there's been a lot of press about, is all the drive-to leisure markets in the U.S., particularly, that have been, you know, running at capacity. And you know, the unfortunate thing is not every day is Friday or Saturday, and even 100% occupancy on the weekends doesn't get you back to a cash flow, a break-even cash flow position until you can start filling those rooms, you know, during the midweek. You know, we've heard a lot of debates about the V versus the U versus the L and the W and the swoosh recoveries. And, you know, we know from past experiences that different sources of demand recover at different rates after a recession or a downturn. So, you know, what I'd like to do is, you know, open it up to the rest of the panel, and, you know, particularly the owners on the panel, and, you know, get their perspective on what they're seeing with their current portfolio and how they see the recovery. So, you know, Kenny, George, Dee, if one of you wants to start, and why don't we start off with you, George, given your diverse portfolio. You know, you with Invest have got a nationwide portfolio, but also diverse in terms of the type of assets that you own. So would be great if you could give us your perspective.
Sure. Yeah, right now we're very happy that we have a limited service portfolio with 53 Comfort Inns. Actually, Ellen, why don't you jump to one of the other guys? I just have somebody coming to my house, and all three of my dogs are barking. So just come back to me.
Yeah, no problem. All right, Dee, do you want to jump in and save George there?
You're on mute, Dee.
All right, Kenny, why don't you start?
Well, kind of along the same lines that George was starting there. We see a little bit more traction in our limited service hotels and secondary and tertiary markets. So while it's not, we're not setting the world on fire, we certainly see a little bit of demand pickup in those hotels. Where we thought we would see additional traction, and we haven't gotten it so far, is in our resorts. We have 2 resorts. And once the province started opening up additional services, our other business really picked up in golf, spa, and our winery business, but we haven't seen the traction in the rooms business yet. So I think that's coming. I think our view is that the recovery is going to be a little bit protracted. It's certainly not going to be a V recovery. It's more going to be like a U recovery. And the real question is that, how long will it go? And I think generally we're seeing signs of a little bit more booking pace into next year, certainly not this year.
Okay, great. That's great, Kenny. And Dee, given that your representation of assets in urban markets, particularly Toronto, would be good to get your perspective on what you anticipate the recovery to look like.
Adam, back in March, we had anticipated that this thing will be over by May, June, and we'd start to seeing occupancies in the 15 to 25% range by summertime, and then building it up to 40% on a 12-month basis. We are not seeing it at all. We're running 5 to 10% occupancy. The good news is that in the last 2 weeks, we are starting to see some leisure activity on weekends downtown. So for the first time past one weekend, we were overjoyed having 40 rooms at the Radisson Admiral, for example, or 30 rooms at the Novotel, compared to 10 rooms or 5 rooms before. So the leisure market seems to be coming back downtown. Airport is pretty tough, except some quarantine business. We don't see a recovery until, frankly, I'm not sure, because we don't have other assets outside, but probably likely early next year. I think this summer is more or less sort of written off. And then depending on the second wave, which we don't talk about, I think there's going to be reluctance for people to travel. And I think this will be more like an L with maybe potential U in the new year. That's what I'm looking at right now. Okay,
great. Thank you. And do you want to comment on, because I know you've got representation in other markets in Western Canada, any insight on that? And then we can bring George back in, because I think, he'll have a perspective as well.
For me, Al?
Yeah, Dee, you go ahead. Do you want to comment on Vancouver or Calgary? Because I know you've got some exposure in those markets.
Vancouver, we're running 7% occupancy right now. We're getting spikes on the weekends as well. Calgary is a disaster with not just COVID, but with oil and gas. So we're finding some challenges in the Alberta market, and Edmonton as well, same thing. So I think it's going to be a prolonged recovery. I think, and what we know today and what we should be doing going forward is a different subject. But I think until the borders open up, until interprovincial borders open up, and the corporate customers start to travel back, I think leisure will do reasonably well in some locations. Maybe George can expand on his limited service, but we're finding that it's going to be longer than we expected right now.
Okay, great. George, are you able to jump in?
I'm dog free at the moment. Yeah. Like I was started to say, the limited service portfolio, which we have 53 Comfort Inns out of our 81 hotels, have performed the best out of our portfolio. Still not stellar. We did in April and May close 25 of our hotels, most of the big city center group and conference hotels, centric hotels. We have opened 12 of those hotels back now, and have scheduled to open up the rest of them by the beginning of August, except for the Hilton Quebec City, which is under a major renovation, not scheduled to open up until January 2021. Our occupancy for hotels that were open in April was 20%. This actually works out to be round numbers. It's 20% in April, 25 in May, and 30. We're tracking to do 30 in June. But then when you look at, because roughly half of our rooms were closed, when you include those, we're 10% in April, 15% in May, and tracking to about 20% in June. The limited service Comfort Inns, and I'm looking at sort of the weekly stats that get sent around to us at the close of business every day. We have a number of Comfort Inns that have been full nights this week, which is nice to see. That's a combination of crew business, where maybe there's some highway maintenance going on, or hydro, or railroad crews, and just some leisure travel that's starting to happen. So like our Comfort Inns were 24% occupancy in April, 32 in May, and we're tracking to about 40% in June. Our mid-scale assets tend to be in suburban markets, and as you know, some of the secondary markets, the larger secondary markets, they haven't fared as well. They're tracking about half of the occupancy of the Comfort Inns, and then of course the big, you know, to Dee's points, the downtown Toronto assets, Calgary, Vancouver, you know, we're just getting those open now, so very low occupancy now, but you know, focusing on recovery and appropriate staffing and getting people back and so on. But hoping for you know, maybe a bit of a spike in July and August as people get out and there's some leisure travel. Certainly, we're not going to see any business from the States or other foreign international business over the summer. But hopefully, Canadians get out and travel, and you know, we can have a reasonable July and August. I think July and August is going to tell us something over the next 60 days. Okay.
That's great, George. That gives us a good, I think, a real good perspective of what's happening across the country, combined with what Kenny and Dee discussed. So you know, I think I was gonna leave this till a little later in the session, but let's just talk about the elephant in the room. You know, here we are, 90 days later. Some of the concessions that lenders have provided were, you know, in that 3 to 6 month period. And I think the big burning discussion that and dialogue that people want to have is all around liquidity. And so, you know, to start off the discussion, and, you know, I know that you guys gave us a good perspective of what you were doing, you know, early on, and that was, you know, obviously 2 weeks into this crisis. But here we are 90 days later, and, you know, I think that, you know, clearly the anticipated recovery is not going to happen. You know, little that we knew at that time, we were all anticipating there was going to be some good growth in demand. And, you know, while George, you talked about some of the growth, I think it's nowhere close to where it's anticipated. So, you know, there is going to be that inevitable question about what's going to happen when those 3 to 6 month periods with the lenders, you know, and I'm talking about the deferrals that the lenders have so kindly provided. So, you know, perhaps to start off the discussion, Mark, if you can, you know, jump in and give us your perspective of what you're hearing from, you know, the lender community that you've been engaged with.
Good, thanks, Alan. You know, just to recap what you had mentioned, the lenders have been very supportive for, you know, the first 3 months. Some have given us another additional 3 months extensions. Some lenders have given a full 6 months, but there is an uncertainty what's going to happen post 6 months. I know some of the credit union systems are waiting from the regulators to see what can be done. And what I'm hearing right now, more from the hotelier's perspective, is across the board, and from guys that have one hotel in a secondary market to guys that have multiple hotels, is really what's going to happen on the post 6 months on the principal and interest deferrals, but also the debt service coverage covenants. You know, the cries that we hear right now is that they are at the mercy of the provincial governments in lifting the travel bans and quarantine period, coupled with the timing of the vaccine in order to stimulate the travel. When all that's in the mix, then we're going to have a direct correlation to the revenues. So what we're hearing is the request that there should be some kind of direct correlation, that when everything kind of opens up and quarantine takes place, that there should be, you know, further support on the principal and interest aspect of it in order to assess the risk of the hotel.
Yeah, sorry, Mark, was there more you wanted to add?
Yeah, no, so it's just going to, no, that's, go ahead, sorry.
Yeah, so, you know, to your point about the interprovincial boundaries, I think, you know, opening up, I think that you know, there is an initiative from several leading organizations in the tourism and travel sector that have launched the Canadian Tourism Roundtable. And, you know, that's the same, you know, one of the initiatives that they're pushing. And so, you know, I think that that is, you know, of utmost importance. But, you know, as I think it was Dee that mentioned, you know, if you think about where we are at the end of June, you know, even if we start seeing that opening, are we going to see a meaningful increase in demand? So, you know, from that perspective, you know, I want to jump back to the owners on the panel and get their perspective of, you know, their view of what needs to happen and what is hopefully going to happen with lenders in terms of the deferrals. So, George, why don't we start with you?
Sure. Listen, the Hotel Association of Canada has been, really, really helpful with the perspective of, helping the government with their programs. So I'll just touch on government programs initially first. The CEWS has been wonderful for our industry. And remember, 90 days ago, Dee was talking about you can keep a hotel open as long as you have enough business to cover your payroll. And now that the payroll is covered to the end of August, it is allowing us to open hotels and to start to fight for business. The CERB, on the other hand, while it's helping individuals, and we're starting to have a little bit of issue with people not wanting to come back. It's not affecting us yet because of the business levels. So we're able to get enough people to come back right now. But from the lender's perspective, very, very supportive. With the 3, 4, 6 month principal deferral, we haven't asked for any interest deferral. We hope we don't have to. But that being said, a special shout out to lenders who have come up and are willing to and have approved advancing additional funds to us in this time, where we're a little bit under levered on a hotel portfolio. It's HSBC has been very, very supportive and creative. In fact, we're doing BDC and EDC facility loans through them. Bank of Montreal has been very supportive in advancing new funds, along with the Canadian Western Bank, who continue to work and try to be creative. But you kind of need to have a hotel or a hotel portfolio that is somewhat under levered going into this. If you've just refinanced, within the last year at 65%, there's probably not a lot your lender can do other than defer interest and principal. To get additional financing at this time, hopefully, you've had a hotel or a portfolio of hotel loans where you've paid some principal down, values have went up a little bit, and maybe you're sitting at 45 or 50% financing. And then in those kinds of scenarios, maybe you can qualify for the BDC and EDC loans, or alternatively, I know what Dee has done, and he'll talk to it, I'm sure. Just get your lender on those hotels to finance a bit more for you. We're going to need additional money. We're working with those 3 lenders that we talked about, and the various government programs. And probably not of interest to a lot of people on this call, but we are applying in the process right now of applying for the LEAF emergency financing for large employers. But you have to have over $300 million of annual sales. So I think at the end of the day, you can leave no stone unturned, which means contribution from ownership as well, wherever you can. I think lenders want to see that everybody is, all the stakeholders are contributing. So leave no stone unturned, because 2021 is not looking the greatest right now, although our latest forecast is going up a little bit. But I would advise people to don't sit on your hands here. Find funds wherever you can.
Okay, that's great, George. And you touched on the EDC program, and I wanted to see if we could get Kenny and Dee perhaps to talk about their experience with first of all their view on liquidity, and then also would be great to get their perspective on the EDC program and the success. So, Dee, do you want to jump in?
I'll go. Alan, listen, with exceptions, there's always exceptions to people like Invest and other groups, but generally speaking, most of the people, there is no liquidity for people. Try and go and borrow money from the banks under the EDC, BDC program. That is such a difficult program for people to access. It's not a liquidity program, it's a sinking. They're giving you a rock in a ship to sink with more debt. That's not a liquidity program. You can't make existing mortgage payments. How the hell are you going to make other payments, knowing what's going to happen in 2021? So it is not a liquidity program. I hope the financial institution and the government are listening, that this is not a liquidity program. It is basically you're sinking them rather than giving life. It's like going to hospital. You're going to give you oxygen to life support, and they say, by the way, before we give you oxygen, can I get your wife's signature for mortgage? Can I get your kid's signature? How does that work? That does not work. So the institutions have to be a partner. They have to be a real partner. You cannot borrow money at 7% and hope to pay it back in 2 years under the EDC loan and have a guarantee fee of 1.8%. Most family owners cannot afford to borrow that money. So the appeal to the institution would be work with your clients, work with owners, give them principal holiday, not 3 months at a time. Why do they give principal holiday every 3 months? Give it for 1 year, because we know it's going to be 1 year or a year and a half before business comes back. Why are we putting through pain and trouble, institutions telling us, oh, give me a star report? There is no star report, no business. Give me this, give me that. What are we going to give them? We'll work with them, we'll cooperate with them, but at least don't put us in every 3 month liquidity principal holiday. We should be getting 1 year, that we should be working with the institution as a partner, financial institution. I think that's my view. And I speak on behalf of a lot of owners who've been calling me. Everybody has got a different circumstance, but I think generally we have to be a good partner with our institutions, be transparent with them, be open to them, and say, listen, it is going to be at least a year before we get business back. So give me 1 year principal holiday, rather than going every 90 days and writing reports and get guarantee fee and commitment fee and this fee. We don't have all these fees to pay. We have to be in a position where the institutions have to work with us as the owners. And I speak on behalf of a lot of small owners who've been calling me. And I think that's the only way we can work together, right? That itself is a liquidity program. I think we must make our interest payments and try and look for government to see if they can find another source of liquidity. And I believe HAC is working with government to revamp the programs, because I don't think, besides George or a few other people, not many people have been able to access the EDC, BDC loans. I guarantee you almost out of 1,000 hotel owners, 980 of them have not been able to get the loan. So we need to lobby through HAC, to the institution, to the banks, to the Minister of Finance, to give us a better program so we can actually access liquidity. We will need liquidity, because this thing is not going away for 18 months. Anyway, Kenny, your show.
Well, first of all, before we bring Kenny on, I just need to say something. I'm so glad that you're not shy, and I will tell you, if in the chat set feature here, I don't know if you guys are seeing this, but there's an overwhelming response of support for what you're saying. So I think that it is important, and I'm glad that you've spoken your mind. And so Kenny, let's get your perspective.
Alam, don't get me wrong. I think the institutions are working with us. I think they are, but they need to be educated. I think rather than going every 3 months, we need to educate our financial institutions. Listen, this is a problem. Unlike SARS, unlike financial crisis, this is a global problem. We went from a health crisis to an economic crisis. We need them to hold our hands. We're not asking for forgiveness. We will pay every single money back, but they can defer. If they can defer principal for 12 to 18 months, that itself is a big liquidity program, right? And it doesn't cost them any money to defer it. They basically amortize instead of 20 year, can become 22 amortization, right? So I think it's important that they are working with a lot of people, but some of them don't understand it or because they're scared. But I think the executives of the banks and credit unions need to understand that and communicate, right, with the owners. Thank you. Kenny.
All right, Kenny, this is going to be a tough act to follow, but here we go.
Yeah, how do you really feel, Dee? No, there's not much to add from what Dee said or George said. I think that we're having the same experiences, and I agree with Dee wholeheartedly that the EDC and BDC stuff just is of no help. I think one of the things that if you dial back to 90 days when we first started seeing the World Health Organization declaring the pandemic, we as a group should have gone to the lenders sooner and asked for more time. I think everybody thought by the time the summer gets here, we may see some traction, but literally we should have asked for some additional time on some of the concessions that we've gotten from lenders, some of the deferrals, and would have put us in a better position rather than having to go back every 3 months and ask for more.
Yeah, I think that's Kenny. I think that's absolutely the sentiment that everyone's feeling, and came out loud and clear. So let's just shift. And we can.
Just to it, I understand that there are constraints with institutions because of banking regulations about impairment of loans, etc., because of if they're in default. But we need to work with institutions and talk about waiving some of the covenants. Most of us are in technical default of all our loans because we don't meet the ratios of 1 to 1.2 or 1.4 for liquidity ratios, right? So we need to educate institutions, and we need to lobby the finance minister or the government to listen, waive the requirement for the banks so they don't get loans impaired. But we need to work and get a forbearance agreement on technical covenant. We're not in default of our loans, but we're in technical default because of not being able to meet covenants. I think open transparency, talking to the institutions and the banks, and making them understand that this is not a 3-month problem. This is going to be a 1 year. So let's get into waive the technical defaults off. We'll keep paying interest every month. Waive the principal. Education process. I think we need to talk to our strategic partners, whether it is the banks and the brands. Even the brands need to understand that too.
Yeah.
Alan, can I just weigh in on the covenants waivers? Lenders have their constraints, and whether it's 3 months or 6 months principal deferral, or in some case interest deferral. Our experience has been they want the covenant waivers requests, or to grant a covenant waiver. They want that to sort of match the interest deferral or principal deferral. And really, at the end of the day, when you have a bad Q2, which we're all going to have, and that in your covenants generally get tested on a trailing 4 quarters basis, whether it's a debt service coverage or an interest coverage, it's impossible now to meet that covenant for the next year. As long as Q2 2020 is in your calculation, you're going to need a covenant waiver for the next 4 quarters. And probably Q3 won't be much better. So really, you're looking at not being able to satisfy covenants till probably into 2022. But lenders are like, no, we'll give you the covenant waiver for 3 months, the same as the principal deferral. But to Dee's point, we're going to have to go back every 3 months, because even though it's a technical default, the debt is not in default, because if you're not paying some principal, you've actually got the lender on side. So it's not, you're not in default on your loan. But without a covenant waiver, you're in technical default. And I don't know about the rest of the owners here, but that puts all of our debt in default with another 10, 11 lenders. So the covenant waivers is going to be a constant battle over the next year and a half, because it's going to take that long to get back on side.
George, but why does it have to be a constant battle? Why can't they just do a 1 year? Why do we have to go in every 3 months? We are trying to focus our mind and energy on getting business going, dealing with employee issues, dealing with severance issues. Why our partners don't understand? Give us the 12 months. I asked them in March, and they said, oh, we'll give you for 3 months. Oh, we'll give you for 6 months. What am I doing 3 months later? I'm going back to them. Taking our energy, negotiating. They're our partners. They should understand of most people. The banks, they got $300 billion from the government day one. What have you got? At least, they should understand. I think communication is very important. I think strategically, maybe we should have a call with all the executives of all the major lenders and get them in a call with HAC and say, listen, this is a problem. Because if their loans are in technically default, there are multiple loans cross-collateralized can get in default, right? So why every 3 months? You are a big guy. You have CFOs and people working with it. Some of us don't have that luxury, right? So we need to plan our outlet for 12 months, maybe 8, 15 months, 16 months, whatever it is. So we get rid of that issue. Now we can focus on getting business into our hotels, and we can deal with employee issues. We can deal with a lot of other issues, right? So at least we are at peace of mind rather than going every 3 months. You have staff to do that. Some of us don't have that luxury because we've laid our people off.
Just to jump in for a second here. I can see the comments and George and Dee, what you're saying about these covenants. It's not unprecedented. We've got a client who's got a loan with a major hotel lender globally. They've waived covenants through the end of 2021. So it's not that there's no one doing it. And if that needs to be broadcast that some banks are doing it to encourage others to jump on the bandwagon. Just wanted to put that out there.
Yeah, well, Carrie, I think that's an important point, and that's I'm glad that you raised that. So, listen, there is I think one other topic that we wanted to talk about, and I know that this is a burning issue, and that's why I didn't want to leave it until later on. I know that we've spent a fair amount of time on that, but I think one of the other topics that we wanted to talk about is just perception about investment sentiment, capital markets, and what's happening on the debt side. So, if you look at transaction activity, and, obviously there are not a lot of deals happening, but if we've tracked transaction activity at the end of the second quarter, it was close to $320 million of transactions that closed. You compare that to 2018 and 2019, it was an average of between $850 to $900 million. And that's a 67% decline. And, we're in a no bid market today, and we don't expect a lot of sellers to even want to willingly sell. So, that begs the question about, if lenders aren't going to be cooperative, what really happens? But, I think that along those lines, I want to get into the discussion of valuation, because I think that that's a key component. We haven't heard from Brian, and Brian, I apologize. We're well into this session, and I'd hoped to loop you in earlier. So, Brian, if you can, touch on your view on valuations and what you're seeing in the capital markets. And then I'd also like to then get Mark to give us an opinion on his view, because I see there's a lot of questions, and I've gotten some direct questions on what's happening on the financing market. So Brian, if you could jump in, please.
Sure. Thank you for having me back, Alum. I guess I'm one of the ones who needs to make a bit of a mea culpa. 90 days ago, I think the expectation was for a much quicker recovery. As Dee mentioned, there was a lot of discussion about pent-up demand coming back later in the year. Clearly, that's being pushed out into 2021. I think just to talk about the recovery and the pace of the recovery just kind of sets the background for value expectations, because a lot of it really is related to how quickly we see that recovery happening. But the only good thing you can say at this point is that we have the four worst months on record behind us, and we're 4 months closer to a recovery. So that's about one of the few positive things I can say about the last 90 days. I think at this point, there definitely is more clarity around the recovery. I think the consensus of opinion is that it's probably a 3-year turnaround. Some predict a little longer, some a little less. And a couple of people have mentioned that really depending on the segment, some will be back sooner than others. I think one of the reasons that the recovery is being pushed out is that, while we did a good job in Canada, I think, of controlling COVID, that certainly isn't the case in the US and other parts of the world. And until they get their act together, it's going to continue to impact on hotel performance here. And so I think that's why this will extend for, I think, 3 years. So to Dee's point, I think it probably is a U-shape, probably more like a Nike swoosh type of recovery. I think that part of the issue is getting a better understanding of what the longer term implications of COVID are in terms of social habits, social distancing, those types of things. Business travel, has that fundamentally changed or not? And we won't really know that for another year or two. In terms of market activity, Alum, you touched on it this year. Certainly since March, very, very little activity. In fact, I can't think of any significant offerings or transactions that would truly qualify as post-COVID. We have seen a couple of transactions in the US which suggest about a 20% drop. I think last time I had mentioned that there were some major trades in the US that were terminated just as soon as COVID had hit. There were a few that were also terminated in Canada. Some were repriced and did end up closing. And from what I gathered, the price adjustment was in that 10 to 20% range. It's, again, in June, virtually no activity. Carrie mentioned earlier on, there have been a couple of trades in downtown Vancouver. Those are hotels that were acquired for social housing. There was another one in Victoria. I'm aware of another hotel that traded in West End of Toronto, again, for social housing. So that seems to be the most active sector right now. And again, for government bodies, it's much cheaper to acquire an existing hotel than have to build a purpose-built facility. I think the lack of activity right now probably suggests that the market has or is transitioning from a seller's market, which we certainly saw up until March, to more of a buyer's market. And I think right now the bid-ask spread is just too much to trigger really any transaction activity. And so we are at a bit of a stalemate right now, and that'll probably continue for a bit longer. I think with the support of the federal government and lenders, that's obviously had a stabilizing effect on the hotel sector. But the longer we go without cash flow, I think there certainly are some owners that will need to dispose of assets just to create some liquidity. With some exceptions, not expecting to see a whole lot of lender-driven activity. It's interesting too that we've spoken to groups, I'm sure everyone has heard from groups that are out there looking. They certainly have capital to buy. And I find that interesting because, I mean, while it's a value play, it also tells you that there's some long-term confidence in the industry. Kenny, I know you went through that in the early 90s when you arrived, and I think that turned out quite well. In terms of value, or at least estimating the paper loss, because I don't think really in this market anyone would necessarily be a willing seller, but we are looking at probably 3 years of impaired cash flow. Clearly that will have an impact on value, but we're also seeing now adjustments being made to some of the investment parameters, so cap rates and discount rates. And the rationale there is that there's clearly more risk associated with the recovery. There's more risk built into those numbers and those long-term impacts that I mentioned earlier. More risk associated, I think, with keeping the same levels of profitability. And so for those reasons, those rates are moving up, or at least that's certainly the market sentiment, likely in the range of 50 to 150 bips. Is probably a reasonable estimate, although people have quoted higher increases, but that's probably a little over the top at this point. In terms of the overall value loss, you hear everything from 0% to 30%. For owners and sellers, it's probably 0 to 10%. For buyers, 20 to 30%. It also, though, really depends on the market and the type of asset. In some of the weaker markets that were in difficulty going into COVID, I think COVID has really been an accelerator. And so I think in some of those markets, you are actually beginning to see some power sale activity. In some of the larger urban markets, these are still high barrier to entry markets, and they're still, it's still very desirable real estate. And so I think 2 or 3 years of income impairment is not going to have necessarily a huge or lasting impact on the overall value of the asset. But again, a lot of it really depends on the speed of the recovery. The sooner a vaccine arrives, I think, you know, the better for everybody.
Okay, great, Brian. Thank you for that. And I think there's, along those lines, there's a question regarding the options for refinancing that just came through. So, Mark, can you touch on that? What are the options available for, you know, whether it's construction or acquisition financing or even just refinancing an asset?
Yeah, for sure. Thanks. You know, essentially where we are today, where we were before, you know, 2/3 of the institutions are still on pause. And we have experienced the 1/3 of the institutions that are lending, you know, they're lending under new parameters. So essentially we need an updated appraisal detailing the impact of COVID that essentially focuses on the revised projections, the expected stabilization period. And that's, of course, depending on your geographic region. So in terms of construction, you know, we're dealing with groups that have already commenced construction pre-COVID and have not aligned their financing as of yet, and therefore searching the market during COVID period. So provided everything else is viable and they're, good management, strong players, etc. I mean, what's new to the lending environment is that we're providing an extra 2 years of an interest only period as opposed to your traditional 1 year interest only, as a lender getting involved acknowledges that in 2021, we're not going to be able to hit covenant, and number two, it's going to take a longer period to recover. So again, not all lenders, only very specific who really like the project itself and want to get into growing with the borrower, are customizing their debt structures accordingly. Refinance is even more interesting, and we had a project in Vancouver whereby you're refinancing today and hotels either closed or operating at 10%. So really what we're relying on is the projection. So the COVID type appraisal, looking at a stabilization period of not necessarily 2-3 years, but essentially 3-4 years, most likely 4 years of stabilization. So do you believe into the 4-year stabilization period? Do you believe into the asset? Do you believe into the borrower and maybe the capacity of the borrower to sustain or to weather any storm? So that being said, a debt structure that could be put in place is where you need to accrue the interest from the get-go, or interest only if we're implementing it today until, for example, 2022, which Brian had indicated, and Carrie as well, that when you hit years 2022, all being well, we're hitting 70-75% of the revenues pre-COVID, and then growing from there for years 23, 24, et cetera. So there are financing strategies available for, again, for the construction or the refinancing or acquisition.
Okay, great. Thank you, Mark. Kerry, I think there were some questions related to valuation. I know Brian gave us his views. Did you have a sense, how are you looking at valuations in this market today?
Yeah, I think, what Mark and Brian were both saying is pretty consistent. You really have to look at what's the stabilized value, and that can be asset and market specific to some degree. But nobody wants to know an as-is value today without knowing what the stabilized value is. So that's pretty critical. Given that we've got a market that's not really going to trade anytime soon, one of the things that we're watching fairly carefully is how lenders are going to react to this, because market value is determined based on a willing seller and a willing buyer, and the bid-ask gap is pretty significant right now. I think the only thing that will sort of trip that is that if lenders are impatient and lenders start bringing assets to market at this time, they'll be bringing assets to market at the low point. Whereas if there's patience, we're going to see a 20% value decline could turn into only a 10% value decline next year. So it's just timing will be interesting. I think we have the advantage of Canada watching what happens in the US. With the CMBS market and that type of thing. I think the US market will be more impatient than the Canadian market. And so we'll be able to watch what lenders are doing in the US and hopefully take the smart path as to retaining value within the assets as we come through this cycle.
Carrie, I think that's a great point, because I think that when you think about the perception of a lender driving a sale versus an owner rationalizing their portfolio, doing it on their terms, I think the value proposition, the value perception is totally different. So I think that's a very, very relevant point. And I think the U.S. We've seen it in the past, right? We saw what happened through the global financial crisis. I mean, when you think about the percentage of receivership sales in Canada relative to what happened in the U.S., it was a significant multiple in the U.S., and it's just the nature of that non-recourse financing in the U.S. versus sponsor-driven financing in Canada. And I think it was at the peak, if I'm not mistaken, I think it was in 2010 or 2009. It was at 10% of the sales. So a far cry from the 30 to 40% that happened in the U.S. So we are nearing our 2 o'clock mark. We've got a few minutes left, and I wanted to, jump back to a more broad discussion. And I think that for participants on this call, I think what would be really useful is to get the perspective from the owners and everyone else on this panel. There are obvious things that we've done, in terms of owners have dealt with deferred payments, and looking at all the stimulus packages and support packages that the government has provided. So I think moving into the third and fourth quarter, I'd like to open it up to the panel in terms of what they think are the best practices to follow, and then looking at ways to stop burning through cash. I think that is the biggest issue that people have. So I'd like to open it up, and I don't want to pick on anyone, but I think that Dee, you had a few thoughts there. So let's get back to you to get that discussion going. Is Dee there?
Sorry, I was on mute. Yeah. I don't know. I think I think we're going to manage big issue arising is going to be employee issues. I think if the business doesn't come back and after the 13-week expires or the 35 weeks and the benefit don't come back, there's deemed termination for employees. So I think that can be a huge liability for a lot of the owners. So we need to manage that and try and lobby the provincial governments. Like in Alberta, mass termination law does not apply. So I think each jurisdiction is different. So I think we need to try and focus on that and manage that really well, because it could be the liability could balloon very quickly. So we're focused on that. Then just digging in every corner, looking for business and see how we can generate more revenue. I think the costs are already contained, and now just looking for sales and build up the business back.
Okay, great, thank you. And Kenny, did you want to jump in?
Sure. No, I think we're kind of viewing this this period where we're not doing a lot of business, obviously, in trying to determine how we might recast our business and think about doing business in the future differently. So a big focus there is how do we deal with employees in the future and benefits and those types of things. The other thing that from a cash preservation standpoint, and really this plays into future business, where we've had construction projects that were ongoing and we had planned to do, a lot of those we've stopped, but we're taking another look at where we don't have the occupancy. We think that if we go ahead and complete the renovation, we have no disruption of business, then maybe we can come out a little bit better in select projects 6, 8, 9 months from now.
Okay. And George, did you have any thoughts on this?
Sure. In addition to what Deepak said, the employee issues going forward, potential severances is a big deal. I know on our latest cash flow forecast that was updated just today, I see a big number in there for severances that wasn't there before. As Dee said, the provinces are all different, but they have been extending the time period that you can have this layoff before you have to sever. But one thing they're not doing is they're not weighing in where you have union agreements. So where you have union agreements, things aren't getting extended. You have to live with whatever's in those agreements. Sometimes it benefits you because the union agreement is a much longer period of time than common law. But in some cases it's shorter. So it is going to be an issue. Unions want their people back to work. They want their union dues and their fees. That's how they survive, and it's understandable. Nobody really wants to sever people permanently. So hopefully we can figure out a way to work with unions to sort of match what the provinces have been doing to extend. And to Kenny's point, I do think it is a right time to try to redefine the operating model. To find efficiencies. Labor is our biggest expense by far, and this is the time to try to look at a new model, be more efficient. It's one of the things that we're looking at as part of our recovery plan. So I think it's important to try to help the margins any way we can going forward as business slowly comes back. And ramping up and bringing people back, and you only have one time to do it and do it right in terms of not bringing too many people back too soon and not enough and so on. So it's going to be a logistical exercise. And I'd also, I know we're running out of time, just very quickly, I'd like to weigh in on the valuation just briefly. There's no question that values have dropped just because short-term cash flow has dropped, and from a discounted cash flow basis, there is some reduction in value. But I just want to make the point that it's temporary. This business is going to come back. This is a health crisis first and an economic crisis second. Business will come back, whether it takes a year, 18 months, or 24 months, and the values will follow. And like all the cycles that we've been through before, whether it's 9/11, SARS, or the financial crisis, the hotel industry has always surpassed its previous peak. And the peak right now is sort of 18, 19. And we will surpass that peak, very confident. And whether that's in 2023 or 2024, we will get back there.
Hey, Alan, can I just weigh in on one other point, please?
Yes, absolutely.
So one of the things that we haven't talked about, and I'll touch on it briefly, is, in redefining our business, the brands are a big part of that. They're going to obviously have to change their model, which affects all of us. So it'll be interesting to see where the brands land on some of these programs, such as free breakfast in focused service hotels. Free breakfast is a thing of the past. So a big part of how we're looking at redefining our business, I think the brands are also doing that. And, we've had brands offer concessions at different levels depending on the brand. And I think that that's something that we need to focus on as well, because over the next, as we've all talked about, the recovery is going to be a little bit protracted, and we need the help from our brand partners as well.
That's a great point, Kenny. And, I think that it is something that, I think is a burning issue with a lot of the industry participants. And I appreciate you raising that. We could have spent a little more time talking about it, but I think you made the point loud and clear. So thank you for that. And unless there's any other comments that anyone else wants to make, George, I do appreciate you ending with those comments, because I think it is so important. While these are, obviously unprecedented circumstances that we're going through, we have to remind ourselves of prior periods where, we've seen significant market dislocation, maybe not as significant as we're going through now, but, through that uncertainty, we've come out on the other side always, and stronger and more agile. And I think that I want to, on behalf of all the people that dialed in, the chat room has been lighting up. I think everyone can see that. I really appreciate everyone's candid view. There's been, I think, an overload of webinars out there. And I think that when we set out to do this, we wanted an open and frank discussion. I think you've all talked about the lenders and the brands and everyone else as being partners. I think that is the most important thing. We have to all work together and come out. So once again, to the panel members, I want to thank you. I know that there's been great feedback from participants. So thank you once again, and stay safe, enjoy the summer, and travel safely.
Thank you.
Thank you very much.
Thanks, Al.
Thanks, everyone.